I'm going to introduce Heath Behncke now from Holon Investments. Heath's a reflection for me of where this industry has been for years, and everyone's just catching up, because when I spoke to Heath a number of years ago and was talking about the space, he said, needs to be safer, needs to be trusted, reputations matter. And it was the tone that was set. So rather than this, I think the image again that is, cowboys in the space trying to do whatever they want, the only conversation I had with Heath was, it doesn't feel safe enough, or we've got to move really conservatively because this is financial services and you can't move too quickly. So very happy to introduce Heath to the stage now and have him speak to Caitlin Long. It's a remarkable story from the other side of the world. Thanks, Heath.
Hey, Caitlin.
Hey there, good morning.
Good morning. I hear you here at blockchain, the Australian Blockchain Week. So look, I really appreciate your time today. I know you're very busy because you're about to launch those banking services. And keep me in mind, I want to be the first Aussie using those banking services. Look, I think to everyone in this room, Caitlin needs no introduction in terms of what she's at and her contribution into the space and overall. And essentially, I think my team counted Caitlin. I think there's nearly 33 states in the United States enacting in the order of 200 bills, either been enacted or about to be enacted, all kicked off by your cowboy state that I could see. And this is actually also then spilled into Australia. So just to let everybody know here, Caitlin actually caught up with Senator Andrew Bragg, our crypto senator, a few weeks ago to help. So she's been helping us with that conversation. So I think it's probably good to kick off there, Caitlin, around a discussion around what in terms of the high-level advice, given you've been through this, in terms of what we should focus on from a legislative perspective in terms of actually getting this right. And I think this will help frame a conversation for a lot of our legislators and people working in Treasury and others in the ecosystem here. So if we could start there, Caitlin, that would be fantastic.
Yes, terrific, and thank you. And good morning to all. It's an honor to be with you. I would start with laying the most important foundation, which is making the crypto ecosystem backwards compatible with the legal system, so that the legal system knows how to handle disputes and that those who own digital assets know that they have clear title to those assets, and a judge in a court of law won't come and attack that. If you make the technology and the law consistent with each other, then there's no risk of a judge trying to overturn the technology. And indeed, we are seeing some lawyers starting to crawl into this sector. It's quite remarkable how long it took for the litigators in the United States to start coming after it, but it's starting now. And if you don't have clear title to the asset, then what do you own? And once you build that foundation of creating clarity on the legal and property law status, commercial law status of the industry, and of course the tax status of the industry, then you can get the traditional financial services sector like the banks and securities brokers to start engaging with these assets. And that's where we are in the United States. It's very early days, and my company, I formed one of the banks that's based in Wyoming, but applied for both a master account and membership to become a Federal Reserve Bank. And we are likely to be the first, but we don't have it yet. We're almost 2 years into a very long process.
Yeah. Thanks, Caitlin. Look, and on Custodia and digital asset custody banks, maybe we can just explain the reason why. Holon as an asset management company could clearly see the legal certainty which you bring in terms of for an asset management entity. And we know you've been inundated by inquiries, of course, from asset managers in that way. But if you could actually explain the reason to why does Custodia exist, and what you guys are actually, what's your value prop, what you're actually solving?
Yes, we're trying to create a utility for the industry for US dollar banking, but the specific utility is settlement. It's all about settlement. That's something I learned when I was working at Morgan Stanley after a 22-year Wall Street career. It is all about settlement, and the slow settlement of securities and the slow settlement of payments creates not only counterparty risk and cost, but also just backs up a lot of hidden, it just ties up a lot of capital. One of the ahas of why the crypto industry has been so successful is that asset managers can turn your portfolios many times a day because your transactions settle fast. So in the United States right now, it's not possible to settle a US dollar against a digital asset because the US dollar firms, i.e. the banks, are not allowed to custody crypto, and the crypto firms are not banks. And so therefore, you actually have two different legal entities, one settling the crypto leg, the other settling the dollar leg. And therefore, you've got all of the issues I just laid out. You've got delays in settlement, so you've got a timing mismatch that creates the counterparty risk, and it ties up capital, whether you're talking about a corporate treasurer, whether you're talking about an individual, or whether you're talking about an asset manager. Somebody's funding that unsettled transaction. And the faster we can settle the transactions, especially if we can get to a real-time gross settlement or delivery versus payment. This has been nirvana that the securities industry has been working on for years. A lot of the reason why it takes so long to settle securities trades is that the fiat currency leg, it also takes so long. And that's especially true in the United States, where the payment infrastructure is very antiquated.
Yeah. And Caitlin, could you just also talk about the structure of Avanti Bank? Look, because our crypto senator, Andrew Bragg, opened up this morning. He was talking about, compensation schemes and, guarantees that are that exist today in financial services, such in banking. So maybe you could outline that for how it's been actually set up and agreed to by the Wyoming people.
So the proposal in Wyoming, actually the structure for it's called Special Purpose Depository Institutions in Wyoming. They are crypto custody banks and they are payment banks. So the deposits are only in US dollars. So there's no deposits of any digital assets of any type. It's only US dollars. And that's what we would keep at the Fed. And our proposal is to keep 100% of those US dollars at the Fed. So unlike a traditional bank that lends on a leveraged basis or fractional reserve basis, these special purpose banks don't lend. And the reason they shouldn't lend is because of this settlement that I was talking about earlier. When you're talking about things that settle in minutes, if a bank is trying to do maturity transformation or taking credit risk, and there's a run on that bank, you can pretty easily see how that bank could get into trouble intraday. The faster payments speed up, the less leverage the banks need to be over time for exactly that reason. And so the gist is that's what Custodia is. We're a custody bank. All the custody is just like securities custody. Think about the big securities custodians, the big Australian custodians, or the global custodians like Bank of New York or State Street. Most of the assets under management are actually custody assets that are not on the bank's balance sheet. And in the case of Custodia, the only assets on the bank balance sheet are customer deposits that are stored at the Fed. Now, we're not approved for that business model yet. We're not operating under it yet, but I'm confident that it's coming.
Yeah, I think actually, Caitlin, since we talked last time, Senator Bragg has announced actually we are actually contemplating a similar version of the Speedies in Australia, realising those very points that you actually make. So we really appreciate your contribution to that conversation. How about we flick on now to banking? I mean, in the US, because my observations, I put my banking hat on as an analyst over years, is that we're seeing like the biggest shifts now like ever. It's like we are seeing a tectonic shifting of the plates. And, I've been on this journey with you guys as a shareholder, seeing all this actually unfold. So maybe it would be great if you could just outline to the audience here what's happening. I think in Australia, we're a little bit removed from this conversation, and traditional bankers here not really quite aware of just how big this shift is that's actually underway. So if you could shed some light on that, that'd be fantastic.
Yes, the biggest shift is that the payment infrastructure for the US dollar is very antiquated, as I mentioned earlier. There are a lot of real-time gross settlement systems that are available, for example, in the UK and in India, and API-based systems. But in fact, the US, and most folks don't realize it, the US payment systems aren't even API-based. And so it's really, this is the reason why, we see securities transactions in the US still settle on T+2 days. I think that's the same in Europe, and I believe it's the same in Australia as well, although I'm certainly not an expert. But again, it's the antiquated US dollar payments that are really causing that. And once we get API-based payments, that's going to speed things up. But of course, we're kind of leapfrogging over the API-based payments and going to crypto-based US dollars. If you look at the stablecoin market, which is a niche market right now, and the reason it's a niche market is mainstream users are really not touching it yet because it's not deemed to be sufficiently safe. That's the aha of what Custodia is doing, trying to get that door open with the traditional banking industry, going right up the middle of the fairway as a full-fledged bank subject to bank capital requirements, all the BIS capital standards, all of the supervisory exams, the bank level, BSA, AML, Anti-Money Bank Secrecy Act and Anti-Money Laundering is what it's called in the US. All of those things. We have the so-called travel rule and enhanced customer due diligence. That high level of bank level compliance has not been applied to the digital asset industry in the United States yet. And I think once it does, we can start to make some of those stablecoin technologies go mainstream. But right now, it's still a niche market that's almost entirely outside of traditional finance. And of course, the banks are scared. They're running scared. They've been our biggest enemies. I think I'm on all the proverbial dartboards of the banks, traditional banks in the United States. It's funny, they reach out to me while at the same time as they're having their trade associations attack me, which is a fun place to be. It's a classic innovator's dilemma. I expected it all, and that will not shock anyone. But what we're really getting at is bringing API-based US dollars, and then of course also bringing the crypto technology to payments, as well as to institutional custody, and having a full-fledged Fed member bank that can do both of those things is a powerful idea, and we're knocking on the door.
Yeah. So can you explain how big a deal is this shift in that you're actually getting access? I mean, this is like the first. This will be my understanding. Like you break through, and then we're kind of on the other side.
Yes, and I've been working actively with the Federal Reserve really it goes back 4 years, because the state of Wyoming worked with the Federal Reserve itself. And in fact, actually the Kansas City Federal Reserve, which is the district bank that's part of the Federal Reserve system that we'd be part of, the district bank worked with Wyoming officials while the special purpose bank charter was being proposed in the legislature. So Wyoming did not act in a vacuum. It is the cowboy state, but it didn't go off and be, cowboys in a vacuum and go off half-cocked, so to speak. It was definitely something where there was a collaboration with the central bank. And if you look at the details of what Wyoming has done, it's hundreds of pages of rules. It's a 750-page supervisory exam manual for bank examiners on how to examine a bank that is handling digital assets, so that the connectivity of that bank into the US dollar payment system can be done in a safe and sound way without causing any default risk to the central bank and without causing any risk to the payment system itself. So much thought went into it, so much detail, and this is why we are as far as we are with the Federal Reserve.
Yeah. So I suppose the observation is like these, and it comes through these trade groups actually talking about crypto rails being just a modern form of banking in that way. So all the banks are now starting to want to get involved in that. But the interesting thing is the structure of banking underpinning a stable coin versus the structure of banking that you actually have. So, which I kind of sit there and look at, actually, you look like you've got a vastly lower risk structure to enable that stable coin to come out as a true payment means with no risk taking whatsoever, unless you call the Fed risky in that way.
Right. Well, and you and I talked about the BIS capital standards when they came out, because the BIS proposed that the banks globally that handle digital assets on their balance sheet, which, to be clear, Custodia is not doing that. We're just a custody bank. All the digital assets are off balance sheet. But the big global trading firms are looking at putting digital assets on balance sheet, and the BIS proposed that they hold dollar for dollar equity due to the price volatility of those assets. And I came out and said, that's not enough capital. And here's why: because there's not enough compensation for the operational risk. Most folks don't think about settlement as being the big risk in financial services because so many failures to deliver in the securities industry or misdirected payments in banking just get papered over. But in fact, actually, there's a lot of intraday credit that takes place because of these the different timing of settlement. And so settlement risk is the big risk. And so this is the reason why I said, look, dollar for dollar equity is not enough because yes, you've got a lot of price volatility, but you also have that settlement risk, and the BIS capital guidelines do not take that settlement risk into effect. So therefore, the right way to plug digital assets, because they literally settle in minutes with irreversibility, which is very different than what traditional financial instruments like Aussie dollars or like securities. They don't settle in minutes with irreversibility usually. And so how do you deal with the operational realities that you can't reverse your fat finger trade and you are going to have failures to deliver, but in failures to deliver in crypto is default. It's not something that you can go ahead and try to get your operational team to fix before the appointed settlement time, which is in the future. That's not the way crypto works. And therefore, this is the reason why it's so important that if it's going to be inside these big leveraged traditional financial institutions, they need a lot more capital than you think they do. Or the alternative is to ring fence them and put them in these non-leveraged institutions that have accounts at the central bank, and they're really just clearing accounts at the central bank. That takes a lot of risk out of the system and enables the traditional market to get the benefit of the technology, because this is powerful technology. It's better, faster, cheaper, and very importantly, programmable with software. And especially in the United States, that doesn't exist yet.
Yeah, and I suppose this it begs the question as we look forward, Caitlin, to think about fractional reserve banking when you think about a natively digital open source financial world. In terms of those comments you just made, where does this actually head for the traditional model in that way, given those comments?
It's so interesting that I see ASX is the sponsor of the day one of your conference. My previous company, Symbiont, competed for the ASX blockchain stack upgrade at ASX and didn't win. But the concept, and to answer your question, the concept is once you get digitally native securities, and then you have digitally native fiat currency, now you can go to essentially real-time gross settlement of fiat versus securities. What's missing, again, is the dollar leg, the Aussie dollar leg piece, the fiat leg piece generally. It's missing because we don't have digitally native fiat currencies yet, but it's also missing on the security side. And I'm so interested in that. Coming from my Wall Street background, where I saw just so many just fudge factors in the settlement systems in the securities industry. And this is one of the reasons why we haven't gotten faster than T+2 trading days to settle a trade, because there's just so much operational labyrinth behind the scenes and so many failures to deliver. And there's a famous case in the United States you may not be aware of down under, which is the Dole Food case in 2017, where the company was acquired, and then there was a lawsuit for more money. There was a settlement, and so they had to pay out additional money. And here's the punchline: they discovered that there were 1/3 more shareholders of Dole Food than there were shares outstanding of Dole Food. So the Wall Street settlement systems created fake shareholders. Those folks really did pay for the shares, but they were buying fake supply. Those shares didn't exist. And it was a lot. It was 1/3 too many. If you think about what that means, that really picked the pockets of the true shareholders of the company, because real demand was being satisfied with fake supply that was just literally made up in the bookkeeping systems. That kind of stuff is unfair. It does suppress the price because you're pushing the supply curve out, and anytime you push the supply curve out, holding the demand constant and all other factors constant, the price is going to go down, right? And so it's just unfair. And I saw a lot of those things when I was running the pension solutions business at Morgan Stanley, and was very, very focused on the power of blockchain technology to fix a lot of those settlement system issues in both the securities industry and in payments. I tried to do it in the securities industry, and I think just like ASX was encountering, it's really the technology is so different architecturally that it can't be just plugged in. It's really a full replacement, and that's why I think you've actually seen the crypto industry grow up independently of the traditional financial system, because the architecture is so fundamentally different. It's not easy to plug it into the traditional centralized architectures. And that's, I think you will continue to see the crypto industry be pretty separate in the way that it grows up. And then eventually the traditional industry will replace their technology stacks with the decentralized architectures. And they'll be just providing layer 2 or layer 3 services on top of them that are centralized. But right now, it's the two are really quite separate, and so you have to be so thoughtful about the connectivity in between the two, especially to make sure that the central bank doesn't have defaults coming from the fact that you're speeding up settlement on the payment side of the fiat currencies through these stablecoin technologies.
Yeah. So in the case of Custodia, then, Caitlin, in terms of with the central bank and the relationship with the central bank, I know you described for me on a couple of occasions just how conservative that is. Could you actually just describe that? So if we went down that pathway here with the RBA, what that would actually look like? Could look like?
So the way the Basel III capital requirements work, when banks take on their traditional maturity transformation or lending roles for with credit risk, they end up taking on a lot of risk in their assets. And the proposal that we have with the special purpose banks is that they would take no such risk. And so therefore the capital requirement, the constraining item is what's called the tier 1 leverage ratio. You probably have some bankers in the audience that are nodding your head. They know what that is. And in the United States, a new bank, a new Fed member bank is not allowed to go below an 8% tier 1 leverage ratio. So here's the punchline in plain English. The Custodia will be holding $1.08 for every dollar of U.S. dollar customer deposits. So it's a totally different paradigm. Most banks hold a fraction of that, and Custodia's proposal is that actually we would have 8 cents of over collateralization in cash for every dollar of customer deposits, and every dollar of customer deposits will also be invested in cash. So it's pretty much the lowest risk the credit risk model that you could contemplate. But there's a very important reason for that, because the bank has to be able to survive a proverbial run on the bank. We have not seen that in the digital asset industry, but we've seen it almost happen in a couple of instances, the original DAO hack with Ethereum. And in theory, the run on the bank could happen in the span of minutes. It's something that could happen intraday. And that's why it's so important that the banks in this industry not take asset risk, or if they're connected to the large financial institutions, they need to be ring-fenced subsidiaries that really do hold all their assets and all their customer deposits in cash, and then handle the crypto off balance sheet. That's the safe and sound way to do it. It's very safe and very sound, but it's different.
Yeah, absolutely. So recently there's an executive order given by Biden around the cryptocurrency industry. So could you just summarize what you've seen coming out of that, Caitlin, hot off the press?
Well, we saw the crypto markets react very favorably that day. And it's so funny because yet again, the market said, I can breathe a sigh of relief that the US government is not going to try to ban crypto. And those of us who've been around it a long time laugh every time that the market comes to that conclusion, because it's the same, it just repeats again and again and again. At some point, the market will realize the US government cannot ban crypto. First of all, it's way too late for that with Bitcoin. It's way too decentralized. I think the last time the US government could have tried to ban Bitcoin was about 2014, a long time ago. It's way too decentralized now. And as you know, there are nodes running all over the world, but also running on satellites, so they're independent of the internet service providers. And I've even seen a Bitcoin transaction happen on ham radio. Okay, so Bitcoin is pretty decentralized and immune to those sort of state attacks, if you will. But it's funny that the market reacted to the Biden executive order as a sigh of relief that the US government was not going to try to ban it. The Biden administration and the Trump administration previously definitely have big critics of our industry. And it's mostly because of the old canards that we all talk about all the time and defend against. It's the use of energy in proof of work mining systems, and it's also the compliance requirements. But we've definitely seen law enforcement in the United States turn a 180-degree circle and conclude that if the crime is being committed with a keyboard, it's traceable, and they'd rather have that than good old-fashioned paper US dollars. And so most of the critics are frankly just not that educated. So ultimately, I think the Biden's administration's executive order was pretty much government-wide. It's a study, so it doesn't really mean much yet. But the big takeaway is the government's not going to try to ban it for the 18,000th time. We can conclude that.
One last final question, Caitlin. We're getting the wrap up. Just on FDIC insurance, do you need, or there's a question of need, obviously you described a structure that obviously doesn't sound like it needs FDIC insurance, but will you be having to engage to get FDIC insurance because of the structure of the market there in the US?
Yeah, that's a great question. We have actually submitted an application to the draft application process to the FDIC, but it's really funny because the question then becomes, what would they insure? Because to your point, if we're holding all of our assets in cash and we're holding an extra 8 cents on top of all of our customer assets held in cash, and that's in cash too, then what really is the need for insurance? But the reason we did it is the President's Working Group in the United States proposed to have stablecoin issuers be insured depository institutions. Now, I knew from working with the state of Wyoming previously with the proposal of the bank charter that it was very unlikely that the FDIC was going to be willing to insure digital assets. And indeed, that seems to be still the case. So there's a little bit of a perfect catch-22. And I've raised the question that I sure hope that saying that stablecoins have to be issued only by insured depository institutions and then recognizing the reality that the FDIC will not insure any new ones, what does that do? It hands the whole industry to the incumbents. And I sure hope that the incumbents haven't been using the regulatory process to slow the innovators like us down. And they're scared of us. And I think with good reason. We have better technology. I'll wrap by saying, it only takes a few hours for any of us to download the Bitcoin Core software and sync a node. With Ethereum, it takes a few days. But one of the big credit card companies in the United States told me they were very proud that they got their integration time down to 3 months. Well, I know which technology is going to win. If the interoperability and ease of integration is we're talking about it, measuring it in hours or maybe days, not months. And so this is why the incumbents are so afraid of us. And then the proposal for us to be a non-lending bank over collateralized, that also means that we pass counterparty credit risk as a small bank that a lot of traditional banks that are small but leveraged would not pass. And so, yes, this is why they're trying hard to block us. But Heath, we've set up a really nice chessboard. It's not done yet, but we're doing this with the best of intentions. It's the right thing for the United States financial system to embrace this technology precisely because of what I just laid out. It's going to win. And so if we stick in the United States with this very old, antiquated technology just to protect the old incumbents, that's definitely a mistake for the United States. And so what we've done in Wyoming is set up a really thoughtful regulatory regime to be able to work with the central bank and essentially set it up such that this industry doesn't blow up the old leveraged traditional financial industry. We can coexist and end up having great bridges for money to move back and forth between the two in a safe and sound manner.
Caitlin, we are lapping this up here in Australia. There's a lot of people over the last 12 months who've actually been submitting a lot of these views to, to help Australians actually along that journey. And I'd like everybody to put their hands together and thank Caitlin Long for coming on today.
Thank you.
Thanks, Caitlin. Cheers.